Good morning once again, and welcome again to the 31st Annual Barron Investor Conference. You've made it to the fifth and final session with our portfolio managers. This session will be talking about large cap, global, high growth, and technology funds. And I have the distinct honor of hosting the portfolio managers that have the highest performing portfolios within Barron Capital over the last several years, so congratulations to you guys. My name again is Frank Majorano, and I head up the family office, registered investment advisor, and bank trust business at Barron Capital. We only have 30 minutes like we've had for all the panels, so we're going to go straight into questions for this. So if I could identify the mic runners. And first, if I could have you all introduce yourselves, the funds that you manage, and your little area of expertise, and we'll go right into questions. Mike, want to start?
Hello, everybody. I'm Mike Lippert. I've been at Barron 23 years now. I'm our head of technology research, so a lot of AI stuff the last couple of years. I manage Barron Opportunity Fund, and I co-manage with Ashim Barron Technology Fund.
Good morning, everyone. Ashim Mehra. I co-manage the Barron Technology Fund. I've been at Barron for 13 years and also lead our internet research.
Good morning. I'm Alex Umansky. I've also been at Barron for 13 years. I run the Global Advantage Strategy, the Barron Fifth Avenue Growth Strategy, and the Barron Durable Advantage Strategy.
So we're going to go into questions. As I mentioned, we have some of our highest performing funds on the stage today. We have some big names, some big companies. We have technology, a very high growth sector that we're talking about. So if I can go right into questions, if I could see the mic runners. We have one right here in the back.
Hello, good morning. Glad to be here. I have a question for Alex. I actually joined your fund in December 2021, which probably was not the right time to join your fund. But I'm happy with your approach and the big ideas. But I do have a question about a couple securities that you had that you did not keep for very long, right? One was Tempus AI, one was Astera Labs, which seemed to only be in your portfolio for a couple months this year. So I'm interested in why they don't fit into the big ideas and why you only had them for a few months. And then the other one I'm interested in hearing your perspective on is Semiconductor. So thank you for taking my question.
Of course. So Tempus AI as well as Astera Labs were new companies that IPO'd, I believe, actually this year. These were 2024 investments. Both stocks had run up very, very quickly. We got a relatively small allocation, and we were not able to fill out full positions. And so what happened was, in both cases, stocks more than doubled, and we were sitting with what I would call a stub position. These were sub 100 basis points, so less than 1%. And then we thought about it, we looked at it, and we decided that we're better off taking the profits and reallocating capital to higher conviction ideas that still had attractive valuations. So those were two. In the Semiconductor, so we're talking about the Global Advantage Fund. In the Semiconductor was a spec, and it's a company that is a play on automotive. It's actually a stock that I think a number of us own. And the valuation there is very attractive. It is underfollowed. It is not really well understood. They have a very large backlog, which has been getting pushed out. So this is a company that we have been scaling in. And I would actually say we probably reallocated the capital from Tempus and Astera into Indy during the year.
Mic runners. Over here in the back, my right.
Hi there, Michael. Great returns the past couple of years, so thank you for that. One of your top holdings is always Microsoft, and it's kind of slowing down, I think, in growth because it's such a big company. Are you going to be scaling back on that, or do you think it's still going to be one of the top growers?
This is for me. Oh, thank you very much. Microsoft, I think, is incredibly well positioned for the world of AI, both with their Microsoft Azure business, which allows you to have the infrastructure and then the connections to OpenAI, as well as their office business, where they're able to put on the desk of all the knowledge workers AI, which they brand name Copilot. So we think Microsoft is extremely favorable position. From a position size perspective, we did slightly reduce it this year to put some money into other what considered to be mid-size software companies. But when we look at the long term for Microsoft, and the analyst right over here, Brian, right over there, just had a number of meetings yesterday, all the checks that we do on Microsoft and where they are in AI, again, both on the Azure side as well as on the software application side, we think they're very, very well positioned. So I do believe we will own a large position, but we slightly reduced it this year, maybe 100 bips, and put that into some other software companies.
Back here.
A long time ago, someone asked the late, great Mickey Mantle what he would say to George Steinbrenner if he was playing ball today, and he said something like, hello, partner. And I think about the relationship with TSMC and NVIDIA, and I understand that NVIDIA has the IP and the software, but they can't get their product to customer without probably the only person who could produce it, TSMC. Yet all the economics go to NVIDIA, it seems, and very little to TSMC on this whole AI growth that they've had. And I understand you own both companies, although they're small positions. How long is that sustainable, and when does TSMC, quote, go back to the Mickey Mantle comment?
Should I?
You want to start? I'll jump in. Go ahead.
Please.
Yeah, go ahead.
I know in the tech fund, NVIDIA's largest position, which it is in the top 3 in a bunch of these funds, and TSM is, I think, our 5th or 6th largest position in the technology fund. But really the answer is that fundamental to their business, TSMC is a manufacturing business, and that has inherent to it a certain margin structure. Whereas NVIDIA is not really manufacturing, they're getting the product manufactured by this company, and more NVIDIA looks and feels like a software business, and their margins, which are more than twice of TSMC's, depicts that. The other part of that is you are going to see, and you're seeing already, TSMC is raising prices substantially, and double digits. So you are seeing that evolution in TSMC. They are, for those people who aren't familiar, TSMC manufactures the vast majority. When I say vast majority, I mean like 80, 90% of the world's leading edge semiconductors. So it is a virtual monopoly. But at the end of the day, they have a certain subset of customers, NVIDIA being now one of their largest, and therefore those economics are making their way down, and TSMC is starting to benefit. I don't know if you guys want to add, Mike.
I think that was great. Yeah.
I just add that it's a great example of capital-intensive businesses compared to asset-light businesses, right? Players get paid a certain amount, managers get paid a different amount. We can debate where the value add is in that food chain, right? But asset-light businesses tend to have significantly higher profitability, and as a result, they trade at much higher multiples. Capital-intensive businesses, which manufacturing is kind of by definition, will have lower margins, lower profitability, and have lower multiples. But both companies are exceptionally profitable today.
Question in the back.
Good morning. I'm curious to hear your thoughts on why you might think Warren Buffett sold 600 million shares of Apple, beyond the financial press speculation. If you have any thoughts on that, and I'm curious if you're buying any of it.
I mean, we read the same speculation that everybody does. I mean, I think Warren Buffett is looking at the world right now and some of the uncertainty in the world, and he wants to be sitting on more cash. We do own a small amount, smaller positions, given it's a massive index position in Apple, in Opportunity Fund, in Technology Fund. I do believe that Apple is still the gatekeeper for our use of digital applications, because most of us do it on the phone. Now, there are absolute challenges in the courts right now, even though, the case was against Google, the one that was, came out this summer, but, Apple's somewhat at risk there. But when it comes to AI, Apple still has a very good position. Again, as the gatekeeper for giving you access to OpenAI and other models, as well as to have their own models on the platform. So we think Apple is fairly well positioned, and my bet on Warren Buffett is he simply wants to put a little bit more cash in his pocket in case the world ends up being volatile and he can be a buyer.
Up back here.
Good morning. November 20th, after the market closes, obviously we know who's reporting earnings. And it's all about NVIDIA. Bars stopped last quarterly report. People listened. I think everybody in this country is watching NVIDIA common stock. And so my question to you is on the Blackwell chip. Jensen says the demand is insane. How insane does it have to be for the stock to continue to rise? And also in relation to Dan Niles' recent comments about possibly seeing some digestive phase maybe coming in mid-2025. Thank you.
I mean, we recently did what we call a Barron bus tour. We do them in SUVs, but all of us and a number of our colleagues were on the West Coast talking to everybody about everything regarding AI. All of our checks, every conversation that we had with any company is we are right now in the arms race phase of AI. To mix metaphors, if you are not in the game, you are sitting on the sidelines. So the big companies, what are called the hyperscalers or the big consumer internet companies, are spending money. The software companies are spending money. You have sovereigns, Middle East, UAE, who say, we want to have our data here and we want to not get left behind in AI. So everyone is spending. So we do think the demand right now, and we can project out for 2025, is significantly more than the supply. Exactly what numbers NVIDIA needs, the street wants them to beat by about $2 billion a quarter. Street numbers are now at a little over $5 for next year. Clearly people want to see those numbers go up. Again, for us, we focus very much on the long term. We think the long-term picture for NVIDIA is excellent. As Ashim says, they're becoming not just a hardware chip company, they're now becoming a software company in many ways, which if we have more time, I could describe. The digestion phase is what everyone is watching. Will there be a digestion phase in AI where the infrastructure is built and now we're rolling out and monetizing the applications? I don't have a great answer on that. It hasn't happened yet. When I've seen other technology cycles, you have had a digestion phase. But way more important than trying to do and figure out how to trade this is to be here and ultimately get here. Now, we've been investors in NVIDIA since 2018, which I'll talk about on the main stage. I mean, 4 years before anyone thought about ChatGPT and AI. So we're long-term. I think this is going to be a very, very good stock for at least the next decade.
I have an answer. Dan Niles is right. The digestion stage will come. It's not a question of if, it's a question of when. We could have told you that a year ago, 2 years ago, right? Because it always does. But the important thing to understand is that this Gen AI is not a flip, right? It's a transformation that will be very important and very long-lasting. And so digestions kind of don't matter, right? The stock has been volatile. It's going to be volatile. We are long-term owners of businesses. We think NVIDIA is at the epicenter of this Gen AI transformation. And so we're going to own it through that cycle. We're going to own it through the digestion, right? But there's no question that at some point it will come. So,
Ashim or Mike, we had a question come in last night about the performance of the funds that all you managed has been so good. So one, I want to ask, is it sustainable, the big companies, technology, is that happening? But I also want to flip that over to Alex to finish that. I know you have a keen focus on risk, so maybe talk about sustainability performance, but also maybe end with how you're looking at risk.
If I could start with the performance piece. If you look at technology broadly, okay, over the last 10 and even 20 years, so long term, over 20 years, technology has broadly outperformed the S&P over 10 years by 900 basis points a year. 9% a year, technology has outperformed the S&P. Over 20 years, that's 500 basis points. So there will be more volatility in technology, but it is where all the growth is. If companies like Facebook or Amazon, which is now considered a consumer discretionary, half the NASDAQ today is considered information technology. If you look at the broader definition of technology, which is companies that are enabled by this change, it would be 2/3 of the market, 3/4 of the market. So you really have to look long term. All the innovation that is happening in the world is happening and is enabled by technology. It is the singular theme and why we've created a fund around it. I'm sure you guys have more to add to that.
Go ahead, Alex, please. I mean, the only thing I was going to say is, the market needs growth, right? For the market to go up, for stocks to go up. And if you look at the world, there's no debate where the growth is happening. There's no debate what age we're in. We are in the age of technology, and as Alex said, I completely agree, we are in the age of artificial intelligence. It is the biggest transformational shift, certainly in the technology landscape since the advent of the internet, and we all know how that's changed the world. We met with somebody on the West Coast who said, no, this is more like the Industrial Revolution. In the future, every single digital interaction that you have, and almost, all we do in life will be digital in some way, our cars, our homes, it will all have AI part of it. And so when you think about where the world's going, I just think it's undeniable. It's going towards technology. What we used to call brick and mortar businesses, we don't even use that term anymore. We now use the term omni-channel because, yep, they may have a physical store or a physical factory, but they also have to have a digital presence with their customers, their partners, their employees. So, Alex, I don't know.
So your question, if I understood it correctly, is this recent great performance sustainable?
Sustainable and in light of risk.
In light of risk. So can we, expect to continue to go up 30, 40, I think we're up 50 plus last year, right? The answer is, of course we can. Absolutely, we guarantee it. No. It is very important to understand that your future returns are negatively correlated to the present and recent ones, right? Simple English reversion to mean. The reason why 2023 was such a great year for most of us is because 2022 was such a challenging year, right? Your future returns are negatively correlated to the recent and current ones. So if we're up, you're up 40, I think, or high 30s, right? We were up high 50s last year. That means we're probably not going to do as well in, over the next whatever it is, right? Normally, returns are, pick a number, 8 to 10% for the benchmarks, right, or indexes. And we try to do, some hundreds of basis points better than that over full market cycles, right? In terms of risk, we look at risk as probability of permanent loss of capital, right? We don't necessarily look at risk as stock price fluctuations. The markets are going to do what they're going to do. Everything is cyclical, right? We're going to guard against the probability of permanent loss of capital. And I think that's what we tend to be good at.
Okay, perfect. Question? Right here.
Hi. It's in reference to the technology fund. A couple of very quick questions. Now, what's the total value of the fund right now?
About $45 million.
For 49.
49. 49.
Yeah. I'm surprised that it hasn't grown faster. I've been in it all year. You know what the returns are, obviously. I have a significant investment in it. Why don't you think it's growing faster based on the returns?
I think it's a new fund. We don't have a 3-year number yet, which is a big thing with institutional investors. And it's a relatively new fund. So I think for a lot of those reasons, now my personal goals and expectations are that this will be, $5-10 billion fund over time, because this is one of the largest sectors largest themes that you can invest in. So I just think it's a matter of time. And as you know, we're long-term investors and we're patient.
I get my Tesla exposure through that fund. Are you thinking about adding to Tesla? I think, 4 or 5%?
It's a little smaller. It's about 3.6, 3.7%.
Do you think this may be a good time to start looking at increasing that exposure?
We took advantage when there was dislocation in the market earlier this year, and I think we're kind of happy with that position size for now. Mike, you want to add to that?
I mean, I co-manage tech fund with Ashim, and we own the size we have in Tesla. An opportunity fund where I've owned Tesla for a lot longer. I think my initial investment was in 2012. So what is that now? 12 years? It's about a 5.5 position opportunity fund today. You've heard Ron. We think the picture is very, very good. We all know what the stock has done recently since the election. And we will watch carefully, and we're long-term investors. And for technology fund, the big advantage we have is the fund is growing even though it's 49 million, it's growing at a fairly fast rate because it's a brand new fund. We're getting capital in, so we're always getting capital, and we have chances to deploy it. And we're trying to be very smart, pragmatic, and long-term thinking of how to deploy it. I would imagine over whether it's next conference or the conference after that, yeah, we will own a larger position in Tesla.
Yeah, right. Right here.
This is strictly a portfolio construction question because you've addressed it already to some extent, but it's amazing how concentrated some of these indexes have become, and it becomes very challenging not to underperform and still remain diversified. How are you guys navigating that?
I would love to just start with this because it's been a pet peeve of mine. Passive is no longer passive. Okay, passive is now what I call dumb active. And what I mean by that is when you have 5 to 10 or more % positions in a passive index, because passive indexes are supposed to be safer, and for the last 20 years they had 1, 2, 3% positions. But now they have 5 to 15% positions. And those positions get reallocated. So there's actually a study which someone did, and they said NASDAQ for the first time in the last 20 years reconstituted, not this last summer, but the summer before that. What happened was the total value of these large positions became so great as a part of the NASDAQ 100 index that they took down the position size of NVIDIA and Microsoft at exactly the wrong time. They lost their investors hundreds of basis points of performance. So you have these passive indexes that have taken in, I mean, the NASDAQ alone has $500 billion, okay, allocated towards the Qs and proxies for it. So they have massive amount of capital, but they're making active bets. They don't know when to sell Google, or that, hey, Apple may or may not be a good stock, or hey, NVIDIA is entering into some kind of more difficult period. They're not active managers. So you're taking active risk in a product where there's no one actually minding the shop. So look, it's unpopular to say in a venue like this or at our firm, I've been a proponent of passive investing for most investors for a long period of time. I think it makes sense. But I do think at this point in time, there's more risk in passive than there's been in the last 20 years because of how big those positions have become.
Alex, I know in your durable advantage fund, the end of Q3, you had 34 positions, I believe, and you've always been more of a concentrated manager or high conviction. You want any comments on your high conviction?
I was going to take the other side on Ashim's on the index thing, but
let's go back and forth. I love it.
Sure. What do you want me to comment on?
I mean, durable advantage. You have 34 positions.
Right.
That's a high conviction portfolio.
It is.
Into the question. If you feel it's been answered, that's fine. We'll go back to the questions.
I'll try to tie the two together.
And you said over-diversification kind of kills alpha.
Yes, absolutely. And indexes, dumb or not, they have been very difficult to beat, right? Magnificent Seven have done so well, and they've become such a large portion of the indexes. I think in the first 6 months of this year, over 100% of performance came from those 7 names. Right, so if you were underweight them, you had little chance of doing particularly well. But I think what we do is, we're obviously benchmark aware. We understand the size of these things. But as active managers, it is our responsibility to find companies that will be benefiting from the same trends, but are perhaps in the earlier stages of their life cycle, of their growth life cycle, right? Even in large caps, such as durable, we are able to find companies that are benefiting from, be it cloud computing, be it digital transformation, be it, Gen AI, et cetera, et cetera. And so it has been difficult, But I think most of us are managing kind of just fine.
Okay, perfect.
I think the only thing I'll add is we do measure it incredibly carefully. It's a different world. I've been doing this, Barron for 23 years. For Barron Opportunity Fund, the index is 52%, the Mag 7. The 1,000 growth is probably roughly the same thing. So you have to be conscious of that. But I don't want to be a Mag 7 fund in any way, shape, or form. So, whether I'm under or overweight one of those names is a really careful, active decision, honestly, based on our research. Opportunity Fund, the two big overweights, and have been for a long time, would be NVIDIA and Tesla. But I own some of the other ones, and some of them I'm vastly under. But this year, we try to differentiate again in what we think of as companies in the steepest part of the S curve. As I said earlier to another question, we took out a little bit of Microsoft and put them in names like Samsara, Cloudflare, for example, Axon in technology fund that we think are much earlier in the growth curve and capitalizing on a lot of the same things that are going on in the world today. And so I was very happy. I wrote about it in my quarterly letter. It's only one quarter that the Mag 7 underperformed in 3Q, and yet Opportunity Fund outperformed. Why? Because it wasn't the Mag 7, it was all the other things that we're investing in.
What I just want to make sure you understand is the focus is not on owning the Mag 7 or not owning the Mag 7. The focus is on getting you a return. None of us owned Meta 2 years ago. We bought Meta within 10% of the bottom, all the funds here, okay? And we've compounded, and we didn't own it because fundamentally we did not see a compelling return, okay? The same is true of all of those stocks. So sometimes this dialogue on Mag 7, non-Mag 7, it doesn't matter. We want to earn a return for you, and that's what we're optimizing for.
Yep. Question, Luke, right here.
Yes, just following up on your comments earlier, responding to the question about Apple and Buffett selling so much, and then talking about other risks, AI, war, and then also Taiwan semi. What about the China risk? New administration coming in seems obviously a lot stronger, depending on the time of the day or what day it is. Obviously, but I mean, obviously we're getting closer and closer to something, possibly. So how do you look at that in general? And then with regard to your portfolios, is there some type of hedging mechanism or just thought around that specific potentially increasing risk?
You want to start?
I mean, we look at it incredibly carefully. We're lucky at Barron Capital. We have a big team. I think I saw Mike sitting back here a second ago. Emerging markets, a lot of focus on what's going on in China and Asia. We have Eitan, who I don't know if he's in here, is going to go on an Asia trip next week. Again, there are some things that we could research and therefore get high conviction in, and some things are just literally unknowable. So over the last, administration, the Biden administration, they've been very aggressive on China. And so in the context of our semiconductor investments, whether it's semi-cap equipment, semiconductor companies, semi-production like TSMC, the restrictions on export have been significant and have had an impact on companies, and we have carefully evaluated that. Are we talking a lot internally about what this next administration will do? Of course, but right now it's a lot of speculation. At the end of the day, when it comes down to chips, they are needed in the world. The most advanced chips, there's not enough of them. So the world needs more of them. So if they're not made on the island of Taiwan, they will be made somewhere else. The CHIPS Act was passed during the Biden administration. I don't know exactly what the next administration will do, but I would believe that it should be bipartisan, that when we look at the world of today, we realize how important the most advanced chips are, that we invest in the United States in the infrastructure to produce these chips. Because the companies that are leading the innovation, like an NVIDIA or an AMD or a Broadcom, are all American companies. And other than ASML, which is a Dutch company, the other leading semi-cap equipment companies, Lam, AMAT, KLA, they're all US companies. So we should probably do more here. And I expect that will happen. Exactly what the politics will be over the next 6 months or a year, it's really, really hard to know.
So the New York Times reported this morning that the chief doge was talking to the Iranian ambassador to the UN. right? Like I'm hoping to hear from him later today, but if you think about what that means, right? I'm incredibly optimistic that the new regime and the new administration is going to be able to solve a lot of problems through strength, posturing, negotiation, but ultimately find a solution that will help everyone, right? So Elon has a lot of interests in China, and he obviously has the ear of the president. And so, in my opinion, a lot of these things are going to be resolved in much better, quicker, more efficient ways. You know, call me an optimist, but you know, before the guy takes office, we're already talking to Iran. I think that's pretty optimistic.
Oh, perfect. So we're out of time. I hope you've been investors in these funds for the last couple of years.